First half of this year has seen some solid market performance despite the bumpy ride and bearish investor sentiment. So, can stocks continue to climb that wall of worry for the second half of 2025? Joining us now to discuss is Damien Fernandez, Managing Director and Co-Head of Global Equity Portfolio Management at TD Asset Management. Great to have you back on the program, Damien.
Always a pleasure, Greg.
What an interesting ride. We're past the halfway point now into the second half of the year. So much drama, and yet we take a look at the S&P 500, the TSX, positive returns, not even that bad, even solid. What's going on?
Yeah, interesting is probably a good adjective to describe it, right? It's probably lacking, I guess, the amount of oomph to it. You said something at the start of the show, which said green on the screen. And if you look at year-to-date returns across all markets, right, whether Europe is up double digits, Asia is up, Hong Kong is up double digits, China is up, like high single digits. The U.S. as of at the end of June was up mid to high single digits. Bond yields have fallen, inflation's falling, WTI crude prices are falling. That wasn't on the bingo card April 2nd, right, Liberation Day. But I think what people have overemphasized the negative. Because the shock.
Why am I not feeling better? I'm looking at this scorecard. It looks pretty good. Why am I not feeling better?
I think when you see your monthly your statement, you'll feel even better, right? I think that's the thing. I think it's psychologically, and there's a few things happening here. One, the current president of the United States is a polarizing candidate, and descriptors of him always are always shaped in the worst outcomes, right? Whether it's like Liberation Day tariffs. In fact, since Liberation Day, what's actually happened is, and you just talked about it in the opening comments, is we've had a walking back of the worst outcomes of tariffs, right? We had a negotiated deal yesterday with Vietnam that was announced on Truth Social. We've, talked about deals so deals are getting done. So what happened initially on Liberation Day was like, oh my God, these extreme, arbitrary, penalizing tariffs are going to be the end state. That was just the opening bid. Like the problem with Donald Trump is that chaos is the operating function, but people can't extrapolate that chaos into worse outcomes because I think the administration fully understands that they cannot have a recession. So what's happened on the ground? We had jobs numbers in the U.S. today. Jobs are fine. Employment is growing. Earnings, we're about to start Q2. Earnings are forecast to be high single digits. They aren't collapsing. You have jobs, you have earnings, you have inflation that's falling. These are conditions that are generally supportive of the green on the screen that you saw earlier. And I just think that people have to, and we tell this to our clients all the time, right? Separate the noise and the narratives from the evidence. And the evidence is what drives markets. And the evidence is, look, it's taken a step down from, the red hot levels it was at the end of last year, but it's nowhere close to recessionary. And I think that's what's supporting markets. You've climbed that wall of worry.
So that sets us up for the second half of the year, which we've now just sort of dipped our toes into. So we just now say smooth sailing, don't worry about anything?
No, look, I wish, right? The adage, markets climb that wall of worry, is apt. Because what normally happens is that people are positioned so bearishly, and then the worst outcomes don't manifest, the market slowly moves higher. The problem is, as I'm seeing it right now from this vantage point, is that people are expecting just all good news and kumbaya and it's going to be great. Like the sentiment, right, how people feel, how they're positioned, is actually no longer very defensive. So to actually move higher for the rest of the year, the reality has to outpace what are now pretty, decent expectations. So, look, I'm not, by no means am I being, we'll wait, let the data drive our decisions. We'll wait to see if we do see a deterioration in earnings estimates, if we do see the economy slow. Like the jobs numbers today, while good, is a slowdown from 6 months ago. Like things are slowing. So the second half of the year, while I think things are fine, I just don't think you should take the first half returns and annualize them. Right?
Yeah, don't times that by 2 and say, there you go.
Yeah, there you go.
Going to be up 16% of the TSX Composite.
Because the first half, you still had a lot of pull forward in demand. People were pretty bearishly positioned, so you allowed markets to climb that wall of worry. As we go into the second half, we're already at pretty high levels. People are less worried now. It doesn't take much to tip the apple cart, so I would be a little. I think we're positive, but I also don't think that you should eyes wide open. We're not, like sentiment right now isn't bearishly positioned, which is a contrarian indicator.
You're saying people aren't very defensive right now where the markets are at and the fact that we're at new all-time highs. That sounds like portfolio construction, maybe not thinking seriously about portfolio construction, being ready for whatever comes.
Exactly. And I think just like most things, right? Most things in life require balance. I think in portfolios, like you require balance right now. You need a mix of both like offense and defense because there is still uncertainty. But I don't want to give across the lines of being very negatively positioned. I would be, look, we would talk defensively and be negative if the data provoked that. Right now, we need to see deterioration in the jobs numbers, deterioration in earnings. We're just not seeing that there. I just don't think you're getting the support of sentiment, which is getting much more bullish.
How nimble do we need to be then? I mean, obviously, in this program, we watch all the data points very carefully. We talk about them before they're released. We talk about them when they're released, cap them off at the end of the week. But as an investor, it doesn't sound like a set it and forget it kind of environment. You need to be watching this market.
I think you do need to be watching this market, and I think you do need to be watching for signs of deterioration. Things we're looking at are like initial jobless claims, because, look, if the U.S. consumer, which drives 70% of GDP growth, if they have a job, they will spend. A good measure is weekly jobless claims come out. Track that. Look for signs of deterioration with jobless claims. The number of people filing for unemployment insurance is increasing. Follow the earnings data coming out. We're going to have Q2 right now. It's going to start in a few weeks. And just follow the trajectory of what people are talking about, the outlooks and earnings. There's a lot of, look, from the end of Q1, you've seen a reduction in macro risks, geopolitical, economic. Where we are today, for the market to move higher, you need things to be better than what's priced in. And that's what we're looking for right now.
I'm thinking back to April when things were getting tough. You are our go-to guy. We'll call you on a Sunday if it looks like it's going to be a rough Monday. Say, Damien, can we get your ear on a Monday morning? And the message you always deliver, and the message that turned out to be, when I take a look at where the S&P 500 now is quite prescient. Calm yourself. Calm yourself, because April was getting rough, and there were a lot of people who were really concerned. I was really concerned about where things were headed, and now not only have we reclaimed it, we have gotten above where we were before that. I mean, is that still something to keep in mind too?
Yeah, I think, look, April you had a fair degree of uncertainty. You had panicky markets. You had drawdowns that, we calculated it. You had over a 10% drawdown in 2 days. That's happened 7 times in 45 years. Literally 7 times in 45 years. We're talking about like an infinitesimally small set of observations. And historically, if you took the other side of that, you were compensated with double-digit returns 6 months out. That was April. Where we are right now, there's a fair amount of bullishness priced in. Like, look, if you ask me jokingly, on November 5th, 2024, the day before election, the S&P was 5,800 around there. I think that's your put, because the president would probably in his term doesn't want to see the market drop below that. But where we are today in the S&P, carving out new highs, a lot has to go well from here. But look, I still think the adage, right? Keep calm and compound on. Just look at this is a show talking about individual stocks and the macro. At the individual stock level, I think there's still a lot of opportunity. And at the portfolio level in markets, we keep saying what we always say, which is just, have a balanced allocation. And right now, we shouldn't be, because the economy is growing, you probably still want to be in equity investments.